Hi there, it's Bill with Smart Trades. It's Monday, August 22nd. It's a few minutes after the close, about 1:05 p.m. Pacific time, and today I'm going to take a look at the very long-term picture on the Dow and as well as the short term, and I'm also going to look at several stocks as well, including Apple. Anyway, if you'd like more frequent updates, please visit smarttrades.com. I update more often there, as well as tweeting, doing live tweets throughout the day, updating my customers. You have to subscribe to the Smart Trades service if you want the live tweets, however. At any rate, here is the Dow monthly going back to the 20s, and a lot of folks will probably have a problem with this chart in that it does not agree with the classic Elliott assumptions that we've got a fourth wave in the 30s and another fourth wave in the 60s and 70s, and rather I'm counting them as 1-2s. Those of you that have watched my videos for a long time will remember all the way back in March of 2010, I had a variation of this same count here, and indeed, let me just stipulate right up front, these are really just labels to kind of put a tweak on the classic view. I'm not necessarily stipulating that this count is correct. Indeed, I may even adjust it in the course of this video. That said, let's look at this this is a log scale, and this is non-log scale, and you'll notice obviously if you take the log scale off, we have a series of very flat 1-2s, and then what is clearly a kind of almost parabolic type rise into what I'm calling our point 3 here, into the year 2K peak. Now, one of the things the super bears are looking at here is that this is a downsloping head and shoulders, and indeed it certainly could be. If we go through 6,000 on the Dow, I would be very concerned, obviously. That said, everything that shapes up as a downsloping head and shoulders doesn't always work out that way. This is a close-up of the mid-60s through the early 80s, and you can see that very similar head and shoulders pattern. And indeed, what's interesting also is the similarity in pattern that you have through the 2009 low, and how much it resembles the move from the late 60s into the mid-70s. If assuming that that is the case, we're somewhere right in here in this pattern, if indeed they play out similarly. But the bottom line is that, as far as the head and shoulders in the 60s, 70s, and early 80s, it didn't work out. It obviously we obviously took off to the upside and rallied through year 2K. The one thing I would also like to bring your attention to, this is the classic Elliott wave count, is that the 1987 decline is actually just about a 38% retracement from the 1932 low. It doesn't look like it on the semi-log scale, but indeed I think on a daily closing basis it's within 20 points of a perfect 38% retracement. And indeed, I had emailed Prector at the time and suggested the possibility that we had a series of 1-2s rather than 3-4s, and mentioned that that the 1987 low was, again, that 38% retracement. And Prector kind of wrote that off and said it was just coincidental. Anyway, that's all the way back in the late 80s that we were talking about the possibility that we had, rather than a series of 3-4s, that we could better label these as 1-2s. Anyway, let's take a look at the current situation here. Now, this is the classic super bearish model for the Dow, and you've got the decline A into 2002, about almost a 3-year decline, B up into 2007, and then they're counting this as a 1-2 and looking for a third wave of C down. Now, let me quote Prector, "Form is paramount." Well, here's the deal. Here's the problem, the way I see it. You've got A down, B back up, and a near perfect 1.62 times A if you call this C. However, if you look at this as a third wave down, form just doesn't work. This, this third wave or C wave is just way too big relative to A. The bottom line is that's the problem I have with this count, is that the relationship of C to A is just not it's just not correct form for Elliott wave. Simple as that. Another thing I have a problem with, obviously the stock market is made up of individual stocks, and the assumption is that we're going in that classic Elliott count somewhere between 40 and 400 on the Dow. Even at 400, you're talking a 97% decline. Let's assume a 95% decline in various stocks. You're talking Apple around 20, Microsoft around 2.5, GE under 4, Boeing under 6, ADM under 3, and Intel under 5. Now, the bottom line is, regardless of what kind of debt crisis we're into and bear market we have, I just see the world as still needing computers and airplanes and food. I just don't see that kind of decline in these stocks unless there's some kind of total disaster. And it could happen, certainly, but I tend to favor that we're going to see a prolonged bear market, but more of a sideways pattern. Here's a short-term chart I put up the other, actually over the weekend, and this assumes that we have a possible C already in place, and then we're rallying back up in an A, B down, and then we'll have a C that could take us as high as about 1250. Now here's the more bearish scenario, and I think you have to respect this count until proven otherwise, and that is that we had a third wave low back on the 9th, and from there we've had an ABC up to about 1208, and we've got an impulse down, possibly just wave 1 of 5 down. We may still be working on that wave 1. If that is the case, the target for the fifth wave of this sequence is down around 1050. Now I've talked about this count in the previous reports, and I'll get into it a bit more later, but anyway, the bottom line is that this, if you are taking the bearish count here, 5 waves down, and assuming that the decline so far is only 1 of 5, I'm looking at 1050 or so for the fifth wave. That said, here's the alternate, more bullish scenario. I shouldn't really say bullish. It still is calling for a decline down to, let's say about 860 or perhaps 1,000 on the S&P. And in this count, we've got, again, our big ABC down to the 2009 low. We'll call that A, and we're working on a B wave back up. Now these numbers are really, just not necessarily plucked out of thin air, but just giving a very, very general idea of what B may look like. And indeed, I think that we've peaked in wave A of B, and that we're going to work on B, and that B could take several years to unfold also, as did A. Here's again the very bearish count, and in this scenario we're going down below 700 and ultimately down into perhaps double digits on the S&P if you're believing that count. Here's the Dow again, and the quote-unquote bullish count, though even in this scenario, again, we've got our ABC of A down to the 2009 low. We've got A complete, probably up here off the recent highs, and from there B will target around 9,600 or perhaps 7,850, and we have the potential of going back up in an A equals C, particularly if we get down to the 7,850 area basis, the Dow. Now, here's something that's a cause for concern. This is looking at Apple on the log scale, and you can see here it's just a classic 5 up. We have an ADX divergence off the highs, and if this count is correct, the previous fourth wave support is going to come in somewhere near 80. Now, if we drop 300 points from high to low in Apple, hard for me to imagine that's not going to put a huge amount of pressure on the market. And whether or not that's going to bring us down to Dow 400, I still have my doubts. That said, if indeed we've got a 5 up in Apple, and Apple is going to correct, on a long-term basis, I do think that absolutely is going to be problematic for the stock market as a whole. The other thing, though, I would bring your attention to, when you look at a lot of these internal waves in Apple, you'll see they don't count out that well. And indeed, even in the Elliott wave principle text, they talk about that although stocks tend to follow Elliott wave patterns, they are not nearly as reliable as stock indices are, because they only reflect a relatively small portion of the population. So let's take this with a grain of salt. Nonetheless, there's your 5 waves up in Apple, and that is certainly something to watch for and be concerned about. Also, I am reticent to even mention this, but we are approaching the 10-year anniversary of 9/11/2001. As many folks have noted, the market was actually declining into the 9/11 date prior to the events of 9/11, and some folks would have you believe that there were people out there that had prior knowledge, and indeed my concern is that we are declining into that anniversary. God forbid something happens, but that date it's a bit spooky, and we are again declining into it. However, I am an optimist, and I'd like to end on a positive note. If you will look here again at the 70s pattern, we have an ABC down to the, I believe, the 1975 low. And that pattern is very, very similar to what we have so far through the current date. And indeed, I think that you can count this ABC as either A, or it's possible even to count it as this is an ABC, X, and then we've got another ABC down. Hard to say, but the other thing I will bring your attention to, that if we do indeed have a sideways correction, perhaps another 5-6 years, perhaps as much as 10 more years, and head sideways, we're going to run into this trend channel that connects the 1932 low, the 1982 low, and that should come in around Dow 6,000, and if we do go sideways here for another, like I say, 5 to 10 years, we're going to run into that channel. One last thing, back in the 70s, during this period here, this second ABC, I was actually on Maui, and I can tell you, even though we were in a bear market, life was good. So in spite of all the problems we've got here, if indeed we don't completely melt down, if we don't have some kind of disaster, even though we may be looking at 5 to 10 more years of bear market activity, it doesn't necessarily mean that things are going to be that bad. At least, again, being an optimist, that's the positive note I'd like to close on. And once again, if you'd like more frequent updates, please visit smarttrades.com. I tweet throughout the day, and you can subscribe there. And I really appreciate you watching. Sorry this video went a little long, but we're covering 90 years of data, and as well as the current market. So it's just the way it is. Anyway, thanks again for watching. Have a great day and a great week ahead. Bye-bye.